Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, the 25th of July, as we record this week. One of those Thursdays when seemingly half the FTSE is reporting, and this time they're doing so in the teeth of a bit of a US market sell-off as well. We've picked a few businesses to discuss today as ever. In a moment, we will begin with Rentokil, the pest control company that's been struggling to integrate its big acquisition in recent times, but has also attracted activist investor and even takeover interest in recent days and weeks. Mark Robinson and Alex Newman will give their thoughts shortly. Mark will also hang around to touch on Centrica, which has seen shares fall quite a way this morning on the back of its own figures. We will also discuss half-year results from the UK's largest listed company, AstraZeneca. Jennifer Johnson and Julian Hoffman will talk about latest figures there and the state of the company's drug pipeline. And in the midst of all that, IC Alpha editor James Norrington will talk us through his cover feature on the investing greats, his own Mount Rushmore of famous names, and what we can learn from them. As I say, though, let's commence proceedings with Rentokil. Good afternoon, Mark. Any pests in your place at the moment?
None that I'm aware of. I don't normally encourage guests to the household. I'm a bit like our colleague Jennifer Johnson in that regard.
Yeah, none of us do. Yeah, it's very sensible.
It was, the statutory figures were a little bit flat, really, particularly given that we're still in something of an inflationary environment at the moment. As you say, the market is still coming to terms with that marquee acquisition of a couple of years ago with Terminix there, which would create the largest sort of entity in the space, or one of the two largest entities in the space in the US. But it's just another question where you get these type of big deals. There's always questions about the multiple, and this one hasn't played out quite as well as Rentokil would have liked. In fact, about a year ago, Phil Oakley in the magazine was looking at the value argument for Rentokil, and he had a lot of positive things to say about the group, the structural drivers, because in the markets it operates, it doesn't come down to discretionary spending for the most part. If you've got a problem, you've got a problem. And Terminix seemed to be like a nice fit within the group too. However, since then, the integration process hasn't gone quite as well as they might have liked. And so I guess part of the reason why there was this speculation in the press about activist investors and private equity is because the group is a little bit vulnerable at the moment. The share price hasn't performed as well as they might like. In fact, it was sold off again this morning. The underlying figures, once currency translations are taken into consideration, weren't all that bad. And it also indicated that the integration has delivered around about $100 million in cost synergies thus far. There's another 50 million in the wings there, so I believe as well. So yeah, the group has also allocated extra monies this year to boost performance in North America. Some of that's going towards the marketing function out there as well, because I think the thinking is that the deal wasn't accompanied by enough hoopla surrounding it, and I just think that they realize they're going to have to be a little bit more aggressive on the marketing front in the United States as well.
Maybe I slightly mischaracterized it at the beginning in that the integration, from everything they've said so far, seems to be going well enough. Okay, they're putting a bit more investment in, as you say. It's arguably more that the underlying market, again, notwithstanding the point about if you've got a problem, you've got a problem, it's more that they've sort of gone big on the US market at a time where the growth is slightly softer than they would have expected. And that does seem to come out again a little bit in today's figures, which are decent enough, but the outlook is a little bit more mixed for the amount of growth they're going to be getting in North America.
It's difficult to square the rates of growth they're talking about against the inflationary environment too, because they're pitching for organic revenue growth in the region of 2 to 4%, or at the lower end of that. And when you look at that range proportionally, it's quite broad. So we can infer that matters aren't settled in the US as well, and that's part of the reason why they're allocating more funds there too. The integration, I've seen much. There's been really bad examples of this in the past. So, Rentokil are doing reasonably well on that level at the moment, but just the whole thing just seems a little bit flat at this time. But it's a value investment, I guess, or perhaps it would fall under quality. James would probably have more an idea about that too. The US in particular, when you look at it from a geographical perspective, North America really is a laggard in terms of revenue and profit growth. But it constitutes the lion's shares of sales at this stage.
Yeah, I suppose it's not every company you can say that about, albeit with some deteriorating economic fundamentals in the US. Maybe we'll be saying it about more of them before too long. I think probably would characterize it as a quality investment rather than value. Going on the basic PE, it's still pretty expensive compared with most companies, albeit in its own sector. I think after that profit warning last October, it is quite a big discount to Rollins, which is the big US peer. Why don't we bring in Alex? Because as we've spoken about, there has been some interest from a couple of people, really. The official interest is Trian, the Nelson Peltz activist vehicle, who have been getting involved. And earlier this week, there were also media reports that the former BT chief exec is looking at a private equity consortium type takeover. So we can take that more as a indicative, I suppose, more symbolic, rather than going into the ins and outs of that, because we don't know about the details. But what do you think, Alex, about this interest in the business from outside parties?
To echo Mark's point, I think it is hard to escape the sense that this takeover speculation and activist involvement kind of at the same time is a reaction to the underperformance. So, we know there are a lot of big, well-capitalised investors out there looking at UK equities for any opportunities. And this is a big international business with the UK listing, increasingly large presence in the US, and a very, as you mentioned, Rollins, a very clear direct competitor which trades on a multiple that is double that of Rentokil's. So whether that is through the traditional activist route of, I think, Trian's reportedly just asking, insisting, not only for a board seat and the CEO to step aside, but for them to relist in the US, and thanks very much, we can just do a 1 year 50% jump or return on our investment. Private equity, it's harder again to second guess exactly where they might see value and their motivations, but one potential avenue might be for them to take it private and then relist in the US in a few years' time, sort of in line with a typical holding period for private equity funds. This is quite a big company, though, for a private equity to take on. And so I think in the Sunday Times report, which was, I thought, pretty credible, detailing Philip Jansen's potential involvement, there was speculation that it might involve several funds. So, yeah, I mean, it's a tricky situation, but we often find ourselves in this position, I think, both on the podcast and writing about them in the magazine, because, I think we all worry about making wishy-washy probabilistic statements about what the chances are of a deal going through and what this all means, because we can't see the decision-making behind the statements that are being put out or not even put out at the moment. But there is a non-trivial chance that a bid is going to emerge in the next couple of months, and if you buy now, that you might make 20+%, assuming a sort of normal premium to the shares. So the chances, the chances of a deal happening at the moment, Deutsche Bank said that the longer these North American issues persist, the greater there is going to be a chance of something happening. Yeah, that seems fairly logical. They are turning things around, but it's, I suppose, the big question really is on valuation and the comparison with Rollins, and if there are some investors here who think they can close that quite substantial gap, then that is going to be a motivator for them. This is a quality business despite its challenges, and if you're prepared to look through the current challenges for the next couple of years, then there's potentially a decent return on offer there, assuming Rollins can hold on to its really chunky valuation of something like 35 times EV to operating profits. So
yeah, we do make the point as well that their valuation, so EV to EBITDA at the moment, stands at 11.5, which is, I looked at it, it was actually well down on the 5-year average ratio. So I don't know if that, comparing the two companies is the quickest way to get some sort of clear air on that one as well. The management as well did point to a $15 million revision to operating profits for the full year. That was again down to the extra monies that they're pouring into the US business. It's really hard though on the face of it to see. I think the shares were down by about 10% when I last looked as well. So it's pretty hard. Maybe that's they did stack up quite nicely when that speculation about the takeover proposal emerged. So perhaps that accounts for it a bit as well.
Just on the valuation point, then, Mark. So I saw in your write up you used the EBITDA EV to EBITDA multiple, which I'm very conscious of not spewing out too many figures on a podcast, but their depreciation and amortization rate seems a bit more aggressive than Rollins. So the gap between EBITDA and EBIT or operating profits is quite wide. So that arguably kind of flattens the valuation for Rentokil, but if you're going to do a direct like for like comparison with their US peer.
Well, there you go.
It does seem potentially to sort of sum up that this activity could put in theory, a bit of a floor under the share price. Shares are about flat today from what I've seen, but we've seen that weakness in the US is going to continue from what they say. It seems the outlook is still, they're trying to strike a positive tone on some progress with the Terminix staff retention, things like that. Some of those numbers are ticking up, but the fact is they expect North American growth to be at the bottom of the guided range, and they're still investing more, so there's still a way to go. But yeah, potentially some room for improvement there, and some backstops in the form of these activists and potential bid interest. We're going to turn now, though, to our cover feature this week, written by James Norrington, looking at the investing greats, or 4 of the investing greats, almost with certainly with Mount Rushmore in mind. You mention it in the piece, thinking of who those 4 would be on the mountain if it were up to you to, I don't know, chisel away at it over a series of years. Can you talk about, I suppose the obvious place to start is who are those 4 people, and also what your thinking was in writing the piece?
Well, the top 4 investors of all time. So what made me think of this was Jim Simons died earlier this year. Of course, one of the greatest investors you've never heard of, a great mathematician, worked as a code breaker for the US government, and was an academic, for very successful prize-winning academic beforehand. So it got me thinking when he died, it'd be nice to do something, and it was a bit, there are obituaries appearing everywhere. But then I thought, well, let's do a comparison of some of the investing greats, and then I just thought of just from my love of watching US sports programs, basketball in particular. They always talk about who's your Mount Rushmore, your greatest 4 NBA players of all time. And I thought, well, let's apply that to investors. And the 4 I settled on, my personal top 4. I mean, obviously Warren Buffett has to be amongst, has to be there. I've also included Peter Lynch, another famous value investor. I think Jim Simons is warrants there, also just for a different approach, a very sort of quant-led approach, incredible returns that he achieved. His firm Renaissance Technologies with their Medallion Fund, and also Stanley Druckenmiller, who is more of a macro guy, but very famously, never lost money with his Duquesne fund, although he did lose money investing on behalf of George Soros in the tech crash in the early 2000s. But Yeah, so those are my top four, and I just think inspire me to think what could you learn from each of these greats, and obviously there are others. People will have their other greats, but I think that those are my four really, just because of the a bit of variation in them as well.
Can we say a bit more about sort of the investing styles of the four, how they compare and contrast?
Well, Buffett's obviously the most famous. He's a classic. He started out as a classic value investor early on in his career. As the size of his funds grew, as sort of Berkshire Hathaway, which sort of started out sort of an insurance based business, as that became more of a conglomerate, so it got bigger and bigger, and the influence of Charlie Munger, of course. He had to find the larger companies, which he couldn't just be a pure value sort of Ben Graham style investor. So he sort of were looking for having thought elephants don't gallop, which kind of was proven wrong, but up until this week with a lot of the US tech stocks. And then he contrasts with another value investor, so Peter Lynch, also more value. But Peter Lynch, unlike Buffett, didn't really take sort of more concentrated positions. He was quite famous for taking lots of positions, investing in more stocks than you would consider you should do. And he very much he had very simple sort of investing principles. Invest in what you know. He also used to like investing in things that he heard good news of their operations and their products and from their customers. Like he was very keen on what his wife thought of companies, things that went in the family shopping basket. So he's obviously he ran the Magellan Fund very successfully for Fidelity between 1977 and 1990. So a great value investor. Druckenmiller is more of a macro guy, famous for getting big calls right. But again, he did very well in sort of the early '80s, around the time of Paul Volcker, and sort of coming off that big bear market in bonds in the '70s. Just what would lead up into what would be the great sort of bull market in bonds, which which carried on really until 2021, late 2021. But he made some big calls on that, got it right. He did very well, with Soros, looking at currencies in at the time of the reunification of Germany. When Soros famously made a lot of money at the UK's expense, and when we were defending the exchange rate mechanism. And then he did very well in the global financial crisis as well. With the one sort of blot in his copybook was the dot-com bubble on behalf of Soros. But really, one of the lessons you can learn from him there was actually he got emotional when he was right. Just a few months too early that these companies that some of them are pre-revenue, never mind pre-profit, and they were on insane multiples of earnings, ones that did have profit. So he was right, but he got emotional and put on and bought the market right at the top famously, and then took a step away and regrouped and came back as strong as ever for the global financial crisis. And finally, Jim Simons is just a quant investor who brought the principles of mathematics, sort of, again, slightly different to Druckenmiller. Druckenmiller always, whilst looking at trends, did think, has said, that he used to think too many people are trying to stick the whole world into an equation. Whereas I think Simons actually maybe has by using a bit of emotional intelligence as well as mathematics, he was able to he acknowledged evolution, that things don't stay still and there's not one equation that stays still. It sort of works forever. His genius was really in always hiring the best and brightest minds to keep building and expanding and working out that sort of algorithms change and evolve. They're living things really, so definitely when it comes to financial markets.
The obvious follow-up question, and one thing you do address in the piece, is how replicable are their strategies or elements of their strategies? Certainly in the case of Simons, Renaissance Technologies, that's a secret sauce, as you'd expect from a hedge fund there, and hiring the best and brightest is good for a business, not really something available to the private investor, but there are lessons you can take.
Well, I would say to a private investor, the closest thing you could do is buy a copy of Investors Chronicle, buying the best and the brightest. If we could,
The big lead up to that joke there. Yeah.
Oh, that's not a joke,
Well,
surely,
no,
Dan.
I know, but I agree. But I feel listeners may think we are somewhat partial in that assessment.
No,
there are other things you can do as well as reading the IC.
I wouldn't be that big-headed to say that. No, maybe on other people's behalf,
Yeah.
But actually, that is a good thing. It's actually listening to good sources is actually a very basic thing you can do, just more generally. But also not getting emotional, as we've had that lesson from Druckenmiller. I think some of the lessons from Simons that he talks about as principles are being factoring in costs into what you're doing. That's very important. That whether you're a huge hedge fund or whether you're a private investor with your ISA, understanding costs. And particularly if you're into, as many of our readers are, into small cap investing, things like spreads matter. They really take a chunk out of your returns, particularly if you were buying sort of auction based AIM stocks. The market makers can take a bit of a chunk out of your returns from what you get in at. So these are.
Sorry, just for those who don't know, you mean the price you think you might be paying inevitably, or in a lot of cases, is not the price you end up paying in low liquidity stocks.
Exactly. Yeah. So there's that's important as well. But also invest in what you know. The Peter Lynch quote. That's a very good one. And Warren Buffett actually, he was asked this at the Berkshire Hathaway AGM earlier this year. A very enthusiastic young man was asking him questions, and basically it came down to being in love with the topic, not just the money. Actually being prepared to do the research, because if you're going to have conviction, then it ought to be backed up by something, which is, I think, is an important lesson for younger investors, particularly who got caught up in sort of the meme stock boom a couple of years ago.
Yeah, and it does in some ways show the limits of buy what you know as well, which is certainly a good starting point. But there are a lot of bad investments. I mean, a lot of bad investments begin in all kinds of ways, don't they? But begin by thinking you know a company because you know the face of the company, perhaps, but you don't necessarily know the details behind it.
Well, it is that is a good principle. Buying a brand is a moat, and obviously, if you like the product of a company, there's a chance that lots of other people do as well. So that isn't that sort of backtracking a bit. That is a very good way to invest, but there's more than one way. There's more than one aspect to look at. You want quality products. You want a strong brand, but you also want to understand the supply chains of a company. You want to understand some of the other macro drivers, and also how much are you paying for it in the first place, which I think none of these great investors ever liked overpaying for anything.
Yeah, well, very wise. Have you ever been to Mount Rushmore? Has anyone here ever been to Mount Rushmore? Doesn't seem like a popular destination nowadays.
I've been to Mount Rushmore.
Can you give us some insight on Mount Rushmore, Julian? Underwhelming? Better than expected?
Well, if you like large figures of presidents, it's definitely worth the trip. I mean, it is quite spectacular. I mean, you have to give it that. I mean, I think the ethics of it is somewhat questionable, but there's another one around the corner of there's a big statue of a mountain carved in the shape of Crazy Horse, which I could also recommend.
There you are.
It may be a while before another great president worthy of being carved into rock, though.
Yeah. Well, I think most of us know the current ones from North by Northwest, the Hitchcock film, don't we? But that's another story. Anyway, that is the cover feature this week. That is available in the pages of Investors Chronicle, which I do agree you should read to become a better investor. If you are interested, it's online as well. We are going to turn now, though, to AstraZeneca, the biggest listed company in the UK. Another one reporting today. Jen, the figures seem fairly decent on the face of it, raising guidance, etc., and yet the shares were down a little bit. What did you take from the results this morning?
Yes, well, I think these definitely are an impressive set of numbers, whatever way you look at it. And, if you're on the board of AstraZeneca today, you're probably looking at this falling share price thinking, can nothing please these people? But I think there are kind of a number of readings that you can do of this reaction to these very good interim figures. One is simply that the market is now expecting a strong performance from AstraZeneca whenever it reports. especially in the wake of this major kind of capital markets event that they had in May. Here we heard management say that it wants to deliver $80 billion in total revenue by 2030, up from $46 billion last year. That kind of ambition naturally requires constant step-ups in terms of earnings. So it may simply have been that this set of figures for the first half of this financial year hit the mark. There's another reading, though, and a couple of analysts have sort of suggested that perhaps people are a little bit apprehensive about the scope for margin development. So core earnings per share were just in line with the market's expectations, whereas revenue exceeded the market's expectations. And this is because operating expenses grew really quickly. So launching and marketing new drugs is inherently an expensive business. So there's potentially a couple of concerns about what margin expansion is realistically achievable for the company. And then there may also have been that kind of almost boredom factor, like, oh yes, okay, AstraZeneca, the biggest company in the FTSE 100, it's wants to nearly double its annual sales by the end of the decade. Of course, it's not going to set those kind of targets if it's not going to meet them. So
yeah, the presence of that, the existence of that Capital Markets Day may have helped the analyst community get ahead of themselves insofar as I think the raised guidance today is being described as in line with expectations.
Yeah.
And it's not raised enough effectively, so that's why shares are one reason why they may be down a little bit. What about the sort of the short term or medium term outlook though? Because it has these targets which you just outlined, but for the rest of the year, I mean, clearly over the last few years, it's flourished on the basis of its oncology, its cancer drugs. Of what do we have coming down the pipeline? Looking at the figures today, some of its bigger drugs, I think they're suggesting a slightly better outlook in the short term, but there's still also people looking to, as ever with a pharma company, what it's got in the pipeline, what's the next big thing going to be.
yes, so if you start looking at AstraZeneca's pipeline, it's very easy to quickly become overwhelmed because it is massive. So the company is expecting more than 40 phase 3 trial readouts. That's when the kind of final data on a drug's clinical performance is made public by the end of 2025. And the drugs that are really generating excitement at the moment are, as you mentioned, oncology drugs. One drug in particular has generated a lot of buzz in recent years. That's Enhertu. It was originally approved for breast cancer, has since been approved for a number of other types of cancer. Then there's a drug that has yet to be launched called Dato-DXd. None of these drugs ever have particularly memorable or names. But yes, so Dato-DXd is being trialled in a number of different types of tumour. I think there are something like 14 trials going on with that drug at the moment. And these sorts of new cancer drugs that get approved in multiple indications or multiple types of cancers are really sort of the key to growth in the near term for AstraZeneca. Dato, as well as Enhertu, that's the other drug, are both what are known as antibody drug conjugates. So that's kind of a fancy way of saying these are targeted treatments using antibodies. You can think of them as sort of like a biological missile, I think is the term. So they kill cancer cells in a more targeted way than traditional chemotherapy while leaving healthy cells alone. And that's sort of why this particular class of drug has the potential to really kind of extend the lifespans of people with certain cancers, and they are just starting to really understand the potential of those drugs now. So that's definitely on the oncology side of things. Those are the ones to watch.
Longer term, there's some non-oncology things at a very early stage. I did see some notes. It's the kind of thing, if you're a pharma company, you want to mention right now of GLP-1, i.e. weight loss drug, which is only, I think, in phase 1 or will be in getting phase 1 data soon. But that's something they're trying to get involved with, understandably, given the successes seen elsewhere.
Yeah, I think that's one of those where, and Pfizer is, most of the major pharmaceutical companies worldwide that don't have a GLP-1 weight loss drug are looking to get one. There's a whole other debate to be had on those as to whether it's already sort of too late because you do have Eli Lilly and Novo Nordisk that have this massive market share, and it's going to be difficult to disrupt. And they also have a kind of massive advantage in that they've been producing these sorts of drugs for diabetes for a while. But I digress. What does AstraZeneca offer outside of oncology drugs? Well, its best-selling drug at the moment is a drug for diabetes, heart failure, kidney disease called Farxiga, which is due to go off patent, I believe, potentially before the end of the decade. It also has a few blockbuster respiratory drugs, like the asthma inhaler Symbicort. So while oncology is really the star of the show at AstraZeneca, there are other drugs that it has in kind of more conventional areas like, cardiovascular diseases that also make money for it. So this is a very kind of deep and wide pipeline that the company has. Which is ultimately a massive advantage. It doesn't face the same kind of patent cliff issues where, a drug has generic competitors that enter the market. As something like GSK. GSK is far more patent cliff exposed than AstraZeneca is. So it is still, current share price, downward momentum aside, it is a very strong company that is very much deserving, I think, of its place at the very top of the FTSE 100 index.
Yeah. No, I mean, I think that all makes perfect sense. On the not to fixate on this, but on the weight loss drug issue, there was just a couple of weeks ago, wasn't there, some good data from Roche, I think it was, which sent their shares up 10% and sent Novo Nordisk down a bit. So there is still potential there for people to get in on that market, albeit AstraZeneca's got plenty of other strings to its bow as well. Julian, what's your view on the company and the valuation, the attractiveness of the shares or otherwise at the moment?
Well, I kind of think that weight loss is an ever-shrinking market, to be honest.
Indeed.
AstraZeneca itself, the thing that people find interesting about it is that the company tends to make quite big claims about its future revenues, which it then meets. So the thing that's got people not quite nervous, but a little bit disbelieving is that they've recently predicted that they might get 80 billion in sales annually, which means that they need about 20 billion or so from their short-term pipeline in order to come through in order to achieve that. We've learned not to scoff at that because when Pascal Soriot 15 years ago when he took over, said that he would double the revenues within 3 or 4 years, nobody quite believed him, and then they achieved that with something to spare. So I think that the message from this really is, if the shares do dip on Astra, it's always a good time to stock up. They're in a situation now where their success is breeding success. So I think it's definitely an opportunity to look at it more seriously. But I mean, obviously they're weighted within the index also means this: when the index falls, the shares will also fall. So the FTSE's been on a losing streak, so inevitably Astra will be as well. But I guess my view is that it is a very, very high quality company these days. It's not the basket case of the mid to early 2000s. So if investors do get a chance, then they should probably stock up on it.
Indeed. Well, we're going to finish with a very brief look at another company now, a bonus company, if you will, given the number of results out today, and that's Centrica, which is seeing what it described, I think, as a bit more of a return to normality after the energy crisis for most people, but not for Centrica because it made a lot of money from it. Mark, you've looked at the figures today. What did you take from them?
Yeah, again, it was another company that was subject to a sell-off this morning as well. On the face of it, you look at the statutory figures, and they've obviously disappointed the market. But I find it hard to believe that this would come as anything of a shock. The company itself has been involved in what might be termed a buyer's market for the last couple of years, certainly. But those conditions have changed now, and volatility has come out of the wholesale energy market too. And given that Centrica earns some of its revenues on the back of trading activities and arbitrage, they've got out the window too. So they refer to it as a normalized market, whatever that means. But it didn't play particularly well with the market. There was an extension of the share buyback campaign as well, but that may have come up short of expectations too. The profitability is going to be weighted fairly heavily to the first half of this year as well, which may have had some influence on the market, and net cash is expected to decline as well. So it was just a case of really, I would imagine that everyone is expecting a fall away in the statutory figures, but perhaps they were just a bit more exaggerated than we first imagined.
Yeah, there's some suggestion that there's going to be a bit more investment required in various aspects of the business too. But yeah, that buyback, 200 million, which I think some analysts were thinking would be about 50% larger than that, which again is just a case of perhaps raised expectations. We've seen a lot of buybacks from companies in recent months, and Julian, you've written on that for the magazine this week as well about the share buyback boom. But yeah, it just goes to show that sometimes with the ever-increasing expectations, if you don't keep ratcheting things up to the same extent, you're going to get punished a little bit.
Yeah, they've got some investment commitments going at the moment, and the company did say that the majority of its business units are on track to deliver on their targets linked to operating profit about 2 years ahead of schedule, but that didn't seem to cut the mustard where the market was concerned. So, it seemed this would have been, people obviously know about that reduction in volatility in the wholesale markets, and it's difficult to believe that wasn't factored into the share price ahead of these results. But I haven't looked into it closely enough to find out what the real culprit might be.
Indeed. Well, for more on that, you can look at our write-up online and in print next week. But for now, we've come to the end of the show. So thank you very much to everyone today. Thank you to you, Mark. Thank you to Julian, to Alex, to Jen, to James, to our producer, Maddie Apthorpe. And thank you to all our listeners for tuning in as well. We'll see you next time on another Companies and Markets show.